Well, good morning, Bob.
Good morning, Bill.
This is FNC's Morning View. I'm Bill Rayburn with Bob Dorsey, and we're going to be talking today about lending, or lack thereof, people getting out of the business. This past week, Wells Fargo announced they were getting out of wholesale lending.
Yeah, getting out of wholesale and then terminating a number of joint ventures they have with some brokers, trying to reduce some of their exposure.
Obviously, the benefits that they receive from wholesale lending is not equal to their cost. Their costs are greater.
Well, part of their cost was a very big fine, you know.
Well, that was for the past. Now, let's talk about going forward. For our listeners out there that may not really realize exactly how wholesale lending works, in the wholesale mortgage business, basically the lender takes applications from brokers and they do the underwriting. So maybe they're also saying that their underwriting is not sufficient to catch these things in wholesale.
Exactly, and you know, and part of that, it's not just the broker's fault in all of this. I mean,
well, if you have a pulse, you need some money.
Absolutely,
that's the broker's attitude.
I thought that was the
that's the lender. That's the lender.
But I think
credit people believe everybody's a liar, a thief, and a cheat.
Which are you, Bill?
Well, we'll talk about that. We'll talk about that later.
You know, I think that the issue is, though, that things are going to be changing over the next few years in the way the whole mortgage market is being managed. First of all, everybody's pulling in to have a lot more underwriting controls. Okay, we see that evidenced with Wells Fargo getting rid of their wholesale division.
And retail, they had lots more controls in retail because they touch the end user, the end borrower, directly throughout the entire process.
Right.
Now we're seeing people still ramp up correspondent.
Yeah, but they're doing it a little bit differently than they used to. Now they're paying a lot more attention to the underwriting that's going on. They're wanting to do a much more thorough review of that underwriting, and in some cases even doing some of the pre-funding underwriting.
Well, actually, we've noticed among our clients in correspondent, it used to be there was delegated underwriting. Some of our listeners are in the capital markets area and may not see the front end of a mortgage, so let's quickly review that. We used to have delegated underwriting, so a lender, aggregator, the purchaser, the downstream correspondent, would approve an upstream lender and their underwriting processes, and they would simply audit those to ensure that the delegated underwriter followed those agreed upon underwriting guidelines.
Right.
Now, in today's world, what's happened?
They're moving that to the downstream underwriter. The big bank that's going to buy that loan is starting to take a much more active role in the underwriting process.
Are you saying trust is gone?
Well, I guess everybody's going to the credits.
It's like trust is gone. And so they're completely re-underwriting what that correspondent lender underwrote to start out with. It's increased the correspondent lender's cost. It was a thin margin business anyway.
Right, yeah, it is. And so, you know, and it's all across the board. People are starting to re-look at the way they're doing business, and some of that's going to change fairly significantly with the way the market is shifting. We're now finally seeing, even the Wall Street Journal finally said that prices.
Did you read the Wall Street Journal? I didn't know you read it. I'm impressed.
Oh,
I thought you already read it.
I read them all. But it's even saying that the bust is over. You know, that real estates are coming back up. Everything's rosy in the future.
Well, and the chairman of the Fed, Board of Governors, has certainly been trying to reinflate that balloon.
Right, and even one of the members who had previously been against the QE3 just came out and said, well, I guess we really do need it. So there may be a QE3 in the
Is this a forecast here? Dr. Dorsey's about to make, we're going to do a QE3?
Well, yeah, I think it's going to happen, Bill. But they're going to need something.
And why will it happen? Why will we do QE3? And we'll bring this full circle. We'll talk about real estate lending and also home equity lending. But why do we think we need, or why does the Fed think we need quantitative easing the third round? And let's talk a little bit about that, what that is, and that sort of thing.
Basically, they use several tools that they have come up with to try and make the cost of funds today much less expensive.
The idea being, if the price of money is low,
right,
that there will be a lot of it borrowed.
Right. And so I think what they're worried about is that there are a whole number of things that are going to be happening over the next several years. The market is indeed coming back, but it's not coming back fast. Unemployment is still very high, and
certainly by historical measures.
yeah, and well, we're seeing some positive indications. This last week, they indicated there were a lot more job openings. We're seeing more people voluntarily leave their jobs, and they don't do that unless they think that are other alternatives. So there are some indications that things are improving, but it's still very, very slowly, and there are a lot of clouds on the horizon.
Well, we saw mortgage applications go down last week, and yet the rates are at all-time lows. How low does it have to go to spur? I mean, that's the real question the Fed is asking as well.
Yeah, I don't know. I think that's the problem. I mean, if you look at the mathematical theory, in order to get this economy turned around, the net rates would have to be negative. And
so we would actually pay somebody, basically, in other words, or they would pay us if we were a creditor,
right,
basically, to loan them money. We would not get paid. That's amazing.
And actually in
the damage
Denmark,
rates went. Yeah, they went negative.
They are negative. I mean, which is crazy.
I mean, real negative.
Real negative.
Not nominal. Or I guess they're nominal negative too. They're nominal
negative, and we've seen real rates be negative, adjusted for inflation, but these were actual nominal rates that went negative, which was amazing.
That's awesome.
But I think people are still concerned about some of the things that are on the horizon because. This past week, the OCC put out their semi-annual risk perspective report, and in there was some amazing numbers on equity lending.
Home equity?
Home equity. HELOCs. I mean, HELOCs have the characteristic that in the first part of your term on your HELOC, you can pay just interest.
Home equity line of credit,
right.
HELOC.
And then at some point, you turn so that you have to start paying the principal too. So that means your monthly payments have to go up.
Well, it really does not matter what your rate is if you have no intention of repaying, right? Some people are underwater and they...
Well, that's true. But I mean, the idea is that if they're paying their interest-only portion now, they may have different thoughts once they have to start paying that equity back as well. And the amounts that we have to pay are huge. They projected out into 2018, and in 2012, this year, the amount of home equity loans where you have to pay equity back is about $11 billion. But by 2018, it's up to $111 billion.
And so the question is, what will happen to the underlying value of that home? And so will we be underwater on those deals?
I'm afraid they will. And I think that one of the problems is that many lenders who own the first don't know about the second and vice versa. They don't really know what's going on in those things. And whereas they may be willing to pay the first, they might let the second go. There are all these programs to support borrowing and help people on the first. There are no programs to help people on the equity.
Well, that's just because we haven't had that as a major problem yet.
Is that the reason?
I think so. That's what it said in the New York Times.
Oh, okay.
I'm kidding.
All right. But it was an interesting report. The percentage of the HELOCs that have gone into the equity position has, in 2009 it was 8%, 10, 9%. This year it's up to 56% that have gone into the equity position.
Those are going to have to repay the principal.
Right. And by 2014 it's up to 93% of them.
Now at the same time, we saw a extremely fast appreciation in equity in previous quarters, as much as 60% gain, because people are amortizing, they're paying down that debt that they owe.
Right, they're paying down the debt, and the market's actually coming back. I mean, we've seen cases in Phoenix where people are actually bidding the asking price up to get the homes.
Because there's limited supply, people are not building.
Right,
jobs are there, they're being created.
Right, and a lot of investors have taken properties off the market too. So, there are some housing shortages, surprisingly enough, in some markets.
Well, let's bring this full circle for today, and let's go back to wholesale lending. We have seen mortgage brokers, who are the front end typically of wholesale lending, come down. They have been significantly reduced in numbers over the last 5 years. And we've seen underwriting standards increase in wholesale lending. Do you think that will continue?
I think it has to for the short run. people are still going to be facing a lot of borrowers out there who are struggling to make their payments, okay, for a variety of reasons. And as a result, people are still going to be concerned about defaults. And if there are defaults, then they have to be very concerned about the underlying value of that property. So I think for at least the next several years, there's going to be a very strong focus on underwriting.
Well, from a aggregating lender standpoint, third-party lending focused on correspondent allows you some risk mitigation because you do have, at least theoretically, a financially viable third party to rely on, that originating financial institution, your upstream correspondent. If something goes wrong and you have a buyback, perhaps you could push part of that off to them. Most brokers in the wholesale channel are not sufficiently capitalized to be able to allow an aggregating lender to push any of that loan back to the broker.
Right, right.
To go along with that, most brokers need warehouse lines of credit, and that represents additional risk. So to perhaps fund some of that, I know correspondents use warehouse lines of credit, but a lot of the brokers may need some warehouse lines of credit as well.
Well, Bill, I'm still waiting to know whether or not you're on the credit side or the lending side.
Well, today I'm on the lending side, all right? This is FNC's Morning View. This is Monday morning. I'm Bill Rayburn with Bob Dorsey. We hope you all have a fantastic day.